Hello, good evening everyone, and welcome to this online session on the basics of Forex trading. This is just one of the online sessions we do at dkbMARKETS on a fortnightly basis where we go through specific topics relating to trading. So today we'll be talking about the basics of Forex trading, the foundation you need to become a good trader, and the building blocks to your career as a trader. So that's what we'll be focusing on today, the basics of Forex trading. It's important as always to remember that trading is vastly different from investing. Because that's the problem most people make, is that they mix the term trading up with investing. When you talk about trading, you're really talking about the short term. You're talking about being in and out of the market in a couple of seconds, couple of minutes, couple of hours, couple of weeks, a couple of months. So trading is short term. You're in and out of the market quite quickly in a short period of time. Whereas investing is long term. So with investing, you're looking at a long-term horizon. You're looking at something typical from 10 to 20 years. So the mentality, the attitude, the strategies, the behavior of a trader is vastly different from the behavior of an investor. They're two totally separate things. So when you're trading, you need to wear the hat of a trader, and when you're investing, you need to wear the hat of an investor. And it's very, very important to remember that. And obviously what we're going to be focusing on today is trading, the trading side of things, especially Forex trading. And this is a very good quote from Warren Buffett. Warren Buffett, he says, risk comes from not knowing what you're doing. And the vast majority of people who get into trading know horror stories about people losing money in the markets. Everyone has heard about people losing money, or they themselves have lost a lot of money in the markets. And most people get scared of trading, get scared of the markets, but it's because most people approach the markets without knowing what they're doing exactly. And that's where the risk comes from. So if you know exactly what you're doing, you've taught yourself how to trade, you've learned how to trade properly, and you're then able to minimize the risks of trading. And that's what we're hoping to do today, just to give you the building blocks for you to build on to be a good trader. Because if you don't know what you're doing, then yes, you're going to be taking a lot of risk and you lose a lot of money. But if you know what you're doing, you'll be able to manage risk and become a successful trader. So yeah, really risk comes from not knowing what you're doing. It's also important to understand what the financial markets mean or what they stand for, because that's another term that tends to be branded around the financial markets, but you need to understand what are the financial markets and what do they comprise of. Now, the financial markets comprise of four major components. So four major components comprise what we call the financial markets. So you have what we call the fixed income securities market, which is where you have the bonds and treasury bills. So that's a fixed income securities market. You obviously have the stock market, or as some people call it, the equities market. So this is where you have companies, stocks and shares. And then obviously you have the currency or the Forex market. And finally, you have the commodities market, where you have oil, gold, coffee, wheat, etc., etc. So these are the four major markets that comprise what we call the financial market. So when you just mention the word financial markets, you're really talking about these four markets in general. So if you want to use the terminology properly, you need to specify which market you're referring to. Because if you just mentioned financial markets, then you're referring to all these four markets: the fixed income securities market, the stock market, the currency market, and the commodities market. And these markets are completely different from each other, because the fixed income securities market is completely different from the stock market. The stock market is completely different from the currency or the Forex market. And the currency or the Forex market is completely different from the commodities market. So again, this is another important distinction to make when it comes to separating the components of the financial markets. The other reason why this is important to do in terms of separate these components of the financial markets and understand that there are different components of the market, it helps you when you're looking at investment risk. Because investment risk, or your tolerance to investment risk, will then determine which of these markets you approach. Now, if you're one who has a low tolerance for risk, or you're risk adverse, then you are looking at investing in the fixed income securities market. So the fixed income securities market, where you can buy bonds and treasury bills, have low risk. So they're low risk markets. The chances of you losing money are quite slim, and your return on investment is quite fixed, so you know what you're going to get, and it's low risk. And obviously, it's sort of like in Nigeria, you can buy federal government of Nigerian bonds for about 10% return a year, 10% annual return. Then we come to the next is medium risk. Now, medium risk, if you're someone that's going to take a bit of a risk in the market, you can then invest long term, and the key word there is long term investment in the stock market. So long-term investment in the stock market will give you slightly better returns, well, much better returns than the fixed income securities market. Last year, the return on the stock market was almost 40% return over the year. So you can see that obviously the more risk you take, the more your returns. And then finally, you have the high risk for those who are not risk adverse, those who like to take a bit of a risk and want to take high risk. Then this is where the trading comes in. And the best markets to trade are the Forex or the commodities market, where you can get about well over 100% return a year. So what we're going to be talking today is trading, which is high risk, and Forex trading. So Forex trading is one of the best markets in the financial markets to trade. And you always have to remember that trading is high risk. And high risk means that there's a very good chance you're going to lose some money. Obviously, with good money management and good technique, you will be able to at least manage your risks and trade safely. So this is very important to understand and realize the different types of risks involved: the low risk, the medium risk, and then the high risk. And then that will then determine which markets you trade. So if you have a low risk appetite, you trade the fixed income securities market. If you have some risk appetite, you can do long-term investment in the stock market. And if you have a high risk appetite, then you can look at trading the Forex or commodities market, especially the Forex market. So the basics of trading, which is what we're going to be focusing on today, the high risk stuff, trading, because trading offers you an opportunity to create another stream of income with good cash flow. So that's the good thing about trading. It can be another source of income, and I always say multiple streams of income is a way to go. So once you learn how to trade and you know how to trade well, trading can offer you an opportunity to create another stream of income with a good cash flow once you have developed your mindset sufficiently and learned the rules of the trade. So there are rules to trading, and you need to learn the rules of the trade. Very, very important. Also, trading may involve heavy losses because, again, like we say, it's a high risk way of trading the financial market. So trading may involve heavy losses, but this can be minimized with the development of a good trading plan. So it's very important to have a good plan, which will obviously incorporate your money management and your strategies, and that will help you minimize these losses. Because without a good plan, you're probably going to lose a lot of money. So to become a successful trader in the financial markets, you must possess what we call the 3 M's. Like I always say, if you apply the 3 M's to every single trade you place, you are guaranteed to be successful as a trader. If you miss 1 M out in your course of trading, you are guaranteed to fail as a trader. So it's as simple as that, really. If you apply the 3 M's to every single trade you place, your success as a trader is guaranteed. If you miss 1 M out as you're trading, then your failure is also guaranteed. So it's very crucial to possess the 3 M's and apply the 3 M's to every single trade you place. So what are the 3 M's? So a successful trader applies the 3 M's, which are the mind, money management, and method. So those are the 3 M's: mind, money management, and method. And the most important M and the crucial M to your success is the mind. A disciplined mind is an absolute requirement for successful trading. The proper terminology for mind is obviously trading psychology, but just to make the mnemonic easier, we've put it down as mind, but the proper terminology is trading psychology. And the trading psychology of the mind is crucial. I mean, it's a huge topic in itself, but you always have to remember that if you can't control your emotions, if you can't control your mind, then you're going to fail as a trader, because it's your mind that determines everything else. And when we talk about mind, we're talking about things like emotions of greed and fear. Those are the two biggest emotions that will severely impact your trading. So if you come into trading with a greed attitude and you're looking to be a millionaire overnight, you will probably take unnecessary risks, you will not apply good money management, and you will tend to lose or wipe out your account in a very short time. So greed is actually one of the biggest reasons why most traders wipe out their accounts in the first couple of trades. It's just out of pure greed. And obviously fear is another emotion, the fear of losing money. And unfortunately losses are inevitable in trading. And if you're scared of losing money, and when you have your first loss, you can freeze, you're scared to trade, and obviously if you don't trade, you can't make money. So fear and greed are the two biggest emotions that can affect your trading. So you can see the mind is a very powerful part of your success to become a successful trader. The other things that can affect your mind obviously is indiscipline, not being able to stick to your plan, being chaotic, not being able to manage your time. So anything that can distract you, anything that can affect the way you think and how you apply logic can affect your trading. So you need to be fully focused without distractions with TV, radios, the phone, or people talking to you when you're trading. Because as a trader, you need to be focused. You need to know that at the time you're trading, and you need to dedicate that time to trading, and know that at that time you're focusing on the market without any outside distractions. So the mind is absolutely crucial in your success as a trader. And that's what you need to remember. But the sad thing about this thing is that 90% of your success is down to your mind alone. And obviously the only person that can control your mind is you as a trader. So you as a trader are the only person that can control your mind, and you're the only person that can control the most important M that will make you a successful trader. So if you can't succeed as a trader, it's really down to you and how disciplined, focused you are, and managing your emotions that can make you a successful trader. So the mind is absolutely important to your success. The second M, money management, is equally as important as the mind, because this is where most people fall apart when it comes to trading due to poor money management. Money management is possibly the most important factor in trading, and the first goal of money management is survival. You need to survive to trade the next day. You should never, under any circumstances, risk your whole capital on one trade. So you need to avoid risk that will put you out of business. So the second goal is to earn a steady return, and the third is to improve on the second. So basically, you should always have it in your mind as a trader, you need to survive to trade the next day. You're not going to make money every day as a trader. You're going to have good and bad days. But the key to your success as a trader is to minimize your losses and capitalize your successes. And you can only do that by having the attitude you need to survive to trade the next day and not blow your account in one day or on one trade. So you need to avoid that at all costs. So again, money management is a key topic in trading, something you need to learn. Again, we do run master classes to go through all these topics in depth, because like I said, the mind, trading psychology, and money management are two important parts of your success to trade, and they're each of them on their own are huge topics on their own, which we'll cover in the coming weeks and months, and also doing our live seminars and masterclasses. We always have to remember the mind and the money management are crucial in your success. And finally, the third M is the method. You must have a plan. You must have a trading plan or a methodology to trade in. And your trade should not be based on tips from friends or colleagues or from the TV. It shouldn't be based on hunches. It shouldn't be based on visions or dreams. You should be able to approach the market in an objective, methodological way. So you should have a trading plan that you've drawn out, step by step, how you're going to approach the market on each day, and most importantly, you must have the discipline to stick to that plan on a day-to-day basis. For our live account holders, we have a 2 weeks live trading session every 2 months. So we trade together live for 2 weeks every 2 months, and all these things we put into practice, the 3 M's, and people see me trade. And we have a plan, which I share my trading plan with all the live account holders, and obviously those who also come for the master classes. You have this plan, and you can see that we tend to be successful when we trade together because we stick to the plan. We apply good money management, and we keep our emotions in check. So the 3 M's are crucial to your success as a trader. Now, why is the Forex market the best market to trade? Because like we discussed earlier, you can really trade any of the financial markets. You can trade the fixed income securities market, you can trade the stock market, you can trade obviously the commodities market and the FX market. But the reason why the FX market is the best market to trade and the most popular market to trade is because there's so many advantages that go to trading the FX market. One, is a very diverse market. So you get good diversification with trading the Forex market because you can trade different currency pairs. You've got the major currency pairs, so you can trade currencies paired with the Aussie dollar, currencies paired with the euro, currencies paired with the pound, with the dollar, with the yen. So there's so many different pairs you can trade. So there's a lot of diversification trading the FX market or the currency market. It's also a global market, which is also a big advantage. And the fact that it's a global market makes it a fair market to trade, because it doesn't matter wherever you are in the world, whether you're in Nigeria, whether you're in China, whether you're in America, whether you're in Brazil, everybody is seeing the same currency quote at the same time. So it's a global market, and also the fact that you're all seeing the same prices at the same time, you're all trading at the same time regardless of which part of the world you are, and you can decide to trade any currency. So it doesn't matter whether you're in Nigeria, you can trade the yen, you can trade the Aussie dollar, you can trade the Canadian dollar, you can trade any of the currency pairs. So it's a truly global market. Another advantage is the 24-hour trading. So there isn't an opening and closing time when it comes to the currency market. For instance, if you're trading the stock market, you have to trade it during the stock exchange opening times for those stocks you're trading. So there are opening and closing times to trading stocks. Same with some commodities and also with the fixed income securities market. But with the currency market, it's a 24-hour market. The currency market or the Forex market is open from Sunday night all through to Friday night. So you really have 24-hour trading. You can also trade the currency market electronically. Again, that's where we come in at dkbMARKETS. Because as dkbMARKETS, we provide you with a trading platform and give you the access to the global markets to trade. So you can trade the Forex market from the comfort of your laptop, your iPad, your iPhone, anywhere in the world. So you can trade it electronically. So that's another huge advantage of trading the FX market. And you have very, very good liquidity trading the Forex market. And we'll discuss liquidity in the next coming slides. So liquidity is a big plus. You have no problems going in and out of trades, taking your profits, trading the FX market. You also trade it on leverage. It's a leverage product, and obviously you have to remember that leverage can enhance your profits, but it can also enhance your losses. And it's a very simple market to trade. That's why I love the FX market. Compared to the other markets, the information you need to trade the Forex market is relatively few compared to the other markets. If you want to trade the stock market, for instance, there's so much information you need to learn. You need to know about fundamental analysis. You need to know how to assess the stock. You need to know when they're doing the earnings release, when the company is releasing their earnings, what's happening to the board. So when you're trading stocks, you're constantly trying to keep up with the news about the stocks you're trading. And there's so much information and so much news related to stocks that's a very difficult market to trade. Same with the commodities, especially if you're trading agricultural commodities. You need to know the seasons for the commodities, the countries that produce those commodities, the political situation that in those countries. Same with oil. If you're trading oil, you need to know the geopolitical situation relating to oil. So there's so much information you need to take on board when you're trading other markets compared with the Forex market, where you only need a little amount of information. And because you can get most of the information by analyzing the chart on the Forex market, it's a good technical market, which makes it also easy to trade. So you find that due to all these huge advantages, it makes FX market the best market to trade. So that's why the FX market is the best one to trade. And that's one I recommend highly to most traders to start trading with. Again, I always advise people you can trade any market you want, but the best and easiest way and the most lucrative one to trade is the FX market. Now, I'll just give you some background to FX trading. Like I said, there's no central exchange for the FX market. Because if you go back to what I said about the financial markets, the fixed income securities market is listed on the stock exchange. The stocks and shares of companies are listed on the stock exchange. Commodities still have the commodities exchange, but the currency market or the FX market has no central exchange. So that means nobody, no country, no individual controls the FX market. It just functions through a global networks of banks, corporations, and individuals trading one currency for another. So basically, it's the markets that control the currency market. Not one country, not one exchange. So it makes it a very, very difficult market to manipulate because there's no central exchange. And again, that's a huge advantage to trading the FX market. Now, the FX market was initially developed to facilitate trade between countries. That's what the FX market started out to be. But obviously, nowadays, it's a large part of the FX market is just traded on speculation, which is what we do as retail traders, on arbitrage and professional trading. So FX trading is not like in the past where it's just for trading between countries in terms of buying goods and services, but now a huge part of the FX market is due to people like you and I trading the market and speculating on currency prices, arbitrage and professional dealing. Now, in terms of liquidity, like I was talking about before, the foreign exchange market is the largest and most liquid of the world's financial markets. You have more than 4 trillion, and I say $4 trillion traded every day in the FX market. So you can see it's a huge market. If you combine the other financial markets together, if you combine the fixed income securities market, if you combine it with the stock market and combine with the commodities market, if you combine all three of them, they are still tiny compared with the FX market. So the FX market dwarfs the combination of the fixed commodity, stock market, and commodities market. It's a huge market. $4 trillion every single day is traded on the Forex market. So that's why it's a liquid market in the sense that, you can get your trades executed quickly. If you make $10 million, you can make $10 million in the market and you can withdraw your $10 million without any hassle. And that's what we mean by liquidity. So getting in and out of the trade is no problem because of the huge amount and the vast amount of money traded every day in the FX market. So you can see why, for all these reasons, why FX is an important addition to a trader's portfolio, and why when it comes to trading, why most traders opt to trade the FX market, or at least have the FX market as part of their trading portfolio. So just like I trade other markets, I trade indices, I trade stock indexes, I trade stock options, I trade commodities market, but the vast majority of my trades are on the FX market. So the FX market is a huge part of my own trading portfolio, as with most other traders. And you can see why for the reasons we've just discussed. Now you have to remember that FX consists of trading one type of currency for another in what is known as currency pairs. So you don't just buy a currency on its own. So you don't just buy dollar on its own, you don't just buy euros on its own, you don't just buy yen on its own. FX trading consists of you trading one type of currency for another in what is known as currency pairs. So FX is a two-dimensional product. This is very important when it comes to trading the FX market. So when you're trading the FX market, you really trade it in pairs, in what is called currency pairs. You trade one currency against another. So like I said, the currency pair is FX is a two-dimensional product, so it's always quoted as the price of one currency against another currency. Now, when you see a currency quote or currency pair, like I said, they're quoted as a pair, and you find them quoted as the price of one currency against another currency. Now, the base currency is always quoted first, and this has a constant of 1. And the base currency is what you're buying or selling. So this is an example here. So you see that currencies, as I'm going to show you shortly on the trading platform, they're always in pairs. So you see currency quotes in pairs like this. You always see them in pairs. And when you see them in pairs, you can see the first quote here is euro. So that's one that's quoted first. So this one that is quoted first is now called the base currency. So whatever is quoted first in that pair is called the base currency and has a constant of 1. So in this example here of euro US dollar, the euro is quoted first, so that's the base currency, so it has a constant of 1. So this will be interpreted as 1 euro will buy you 1.2619 US dollars. And it's this base currency that you're buying or selling. So if you're speculating that the value of the euro is going to go up, then you will buy this currency pair because it's the euro you're buying. And if you speculate the value of the euro is going to fall and you want to sell the euro, then you will sell this currency pair because it's this base currency you're selling. So you also have to remember that it's the base currency that you're buying or selling. Very important when it comes to you placing trades on currencies. It's always remember that the base currency is always quoted first. It has a constant of 1. And it's that base currency that you're buying or selling when you're placing your trades on the currency market. The other thing you need to understand in trading is the pips. Now the FX market or the currency market, increments are measured in pips. And pips just means percentage in points. That's what pips mean. So pips just mean percentage in points. Now a pip is the 4th digit from the decimal point. A pip is the 4th digit from the decimal point for all currency pairs. For all currency pairs, a pip is the 4th digit from the decimal point, except for currencies paired with the Japanese yen, where the pip is the 2nd digit from the decimal point. So this is what I mean. So for all currency pairs, so for any currency pair you see, so long as the yen is not in that pair, so if it's euro US dollar, pound, euro, Canadian dollar, Aussie Canadian dollar, so whatever currency pair you see, so long as the yen is not within that pair, the pip is the 4th digit from the decimal point. Now once you see the yen in that pair, the pip is now the 2nd digit from the decimal point. And it's from this pip you make your money as a trader. So for example, if this quote on your trading platform, which I'm going to show you shortly, if this quote of euro US dollar goes up from 1.4127 to 1.4128, you say it's gone up by 1 pip. If it goes up from 1.4127 to 1.4137, you say it's gone up by 10 pips. Because you will now see shortly on the platform that you then choose how much you want to risk for each pip movement. So if you want to risk, if you set your platform to risk $1 per pip for that trade, then for this example here, for the Euro US dollar here, if you're risking $1 per pip, then if it goes up from 1.4127 to 1.4137, so it's gone up 10 pips, and you're risking $1 per pip, then you've made $10 in that trade. If you're risking $10 per pip, then for that same 10 pips, you made $100. If you're risking $100 per pip, for that same 10 pips, you made $1,000. So you can see that that's why it's important to understand how to work out the pips on your platform or when it comes to trading. Let me just show you what I mean by that. We just go to the platform. So this is a dkbMARKETS trading platform, which you can open an account and trade. So you can either open a live account or a demo account. So this is the Euro US dollar here. So let me just bring up an order ticket. I'll just click here on new order. So that's an order ticket. So you can see here that's the Euro US dollar. Now if I change this volume you can see here is at 1. So on our platform, if you select a volume of 1, that means each pip movement is equivalent to $10. So it's $10 per pip. So at a volume of 1, you're risking $10 per pip. So it's very important to always remember that. So if you don't want to risk $10 per pip, or you just want to risk $1 per pip, then you just change that to 0.1. So once you know that a volume of 1 is $10 per pip, then you can work out the rest. It's just a question of doing your maths. So if a volume of 1 is $10 per pip, then if you only want to risk $1 per pip, you reduce it to 0.1 volume. If you only want to risk 10 cents per pip, then you can reduce it to 0.01, and on and on. And you can see that's the market there. You can see the Euro US dollar is 1.3432 at the moment. So that means 1 euro will buy us 1.3432 US dollars. And like I said, although there's a 5th digit here, you work out your pips from the 4th digit. So that's why it's important to understand the pips and also the currency pairs. As you can see on the left hand side of my screen, where you see the markets you can trade on our platform, you can see all the currencies there are all in pairs. So you can see you can only trade currencies in pairs. Okay, so that's very important to remember that. So these are just some of the basics you need to remember when you're trading the Forex market, or when you want to approach Forex trading. So it's very important to remember these basics, what currency pairs are, what pips are, and obviously why it's important, or why the Forex market is the best one to trade. Okay, so that's pips. And obviously finally, for you to trade, you need to have a trading account. So opening a trading account these days is very easy. It's now very easy to open an online trading account. Like I said, our own online brokerage firm, dkbMARKETS, we're professional traders. We're actually a company run by professional traders, and we have offices in Nigeria, London, Europe, and Australia. But we are mainly focused in Africa and trying to educate people in Africa on how to trade. Of course, you can go to our website for further details at dkbMARKETS.com and on how you can open an account. You can open a live account or a demo account on our website, dkbMARKETS.com. If you just go to the Forex side, you can open a live account, you can open a demo account. Obviously, we have educational tools. Like I said, we do have live seminars like you're attending now. We have free live seminars on a fortnightly basis. We have live online live seminars in person. We have master classes. And obviously for live account holders, we have live trading sessions on a weekly basis. Okay, oh yes, you can also go to our YouTube channel, youtube.com, to watch educational videos on trading and topics on trading. So again, that's something there to help assist you with your trading. Okay, so that's more or less it on the basics of Forex trading. If you have any questions, do click the hand button on your control panel or send your questions through to the question box. Like we said, we do this sessions on a fortnightly basis. We pick different topics, and like I said, we also have live seminars, master classes which you can join, and of course you can contact us by email if you have any questions. We also have a Facebook page which you can like us on our Facebook page and join the Facebook page, or follow us on Twitter. So there are various ways you can get in touch with us if you have any questions on trading or on the markets or on our platform for that matter. Okay, any questions, comments?